Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here, working as the Chief Executive Officer of Treasury Consulting LLP, which is a limited liability partnership firm incorporated in India. And today we are going to speak about one of the interesting and very beautiful topic, which is credit derivative wings trade. As we understand that there are a lot of derivatives which are across the globe, like foreign exchange, which covers cash flow, revaluation, which covers revaluation exposure, your derivative trade, your interest rate hedging, which cover interest rate, your so-called credit derivatives, which cover the credit risk. In this credit derivatives, we are going to cover one topic, which is wing trade. Now, we need to understand, before moving ahead, we need to understand one aspect on which this credit derivative is based upon. This particular example of wings trade is based upon a concept called CDS. CDS stands for credit default swaps. Assuming today I am buying a SBI ATI. ATI stands for additional tier 1 bonds, which assume SBI raised at 5% dollar yield. I am never sure that, nobody is sure that SBI can be busted, considering the fact that Indian banks are having more than $6.3 trillion of toxic assets. Any Indian bank can bust. So what do? I will take a CDS position on SBI, which is roughly trading at 2.5%. China CDS position is trading at 108 basis point, which is roughly 1088%. What is CDS position? I will go to I am a CDS buyer and there would be CDS seller, assuming JP Morgan. Since I am a CDS seller, I will go to seller and ask a protection that if SBI defaults, then you will pay me my investment. Of course, there are a variety of CDS, one trigger CDS, two trigger CDS, one basket CDS, multiple basket CDS. There are a lot of kind of CDS. But for the sake of simplicity, we assume that we are here saying that if my total investment in this approximately $1.5 billion, then in the case of default, he will pay me 1.5 billion. Shares versus shares, cash versus cash, so on and so forth. So they have different variants in CDS. Now in this I need to pay some protection money to seller every year. This is just like your car insurance. All those who are watching the video, they know that they must be having a car. In the car you are paying an insurance premium every year. After all, assume you cover third party also. Violence, mishappening, archery, lightning, I would say accidents and everything, even third party, you are paying an insurance. God forbid, if anything do not happen, it is good. If anything would happen, you will pay the money. The particular insurance company will pay you. For that, you will pay an annual premium. There are many cases who are paying premium since years, but nothing has happened. Everything is gone. So, but in that is what CDS is all about. At least you can sleep that your car is secured and safe. Similarly, is the credit derivative wings trade. Now, what do you mean by wings trade? Technically buying shares and default protection at the same time is known as a wing trade. The wing trade's dealing combination is specifically designed to take large profit when the extreme changes in the underlying entity would occur. Now, I will take an example of an entity which is currently in the news for negative reasons, say Twitter. We know that Twitter is not performing well. It's a public company in US. I think there are a lot of rumors on the Bloomberg TV that Twitter will sell himself also. Now, assuming Twitter's share price is trading at $37, the high share price of the Twitter in the lifetime is $85. The lower price of the Twitter is $15, and currently it is trading at 37. And there are a lot of talks in the market that Google will buy Twitter. And I am an investor in a Twitter debt. So 2015, Twitter issued a debt of $15 billion at LIBOR plus 150 basis point for 10 years. I am an investor in that. Now I have a concern. What would happen if Twitter will down? What would happen if Google will not buy? What would happen if the business model of the Twitter will fail? What would happen if it would take over by some Chinese company? What would happen if the corporate governance fail? There are a lot of speculations I have in my mind. I will go to a CDS buyer. Assuming this CDS buyer is JP Morgan Chase. With this CDS buyer, I will sell the same CDS for 10 years, and assuming the cost of this CDS is, this L plus 120 basis point, assuming. Now to JP Morgan I am paying L plus 120 basis point, and Twitter is paying me L plus 150 basis point. So the difference of 150 minus 120, which is 30 bips, is something which is the net earnings for me from this deal. Now what would happen? I will create a wings trade. I will go and buy the Twitter shares. Suppose I will go and buy the equivalent shares of Twitter. I will go and buy the equivalent shares of Twitter. In this, what would happen? I will buy the shares and I also buy the CDS at the same time. And I am waiting for an event that an extreme thing would happen. But remember very carefully in your mind that wings trade is an unsuccessful strategy if this company won't declare a dividend. Then you are gone. Because wing trade is buying shares plus CDS. In CDS you need to pay the premium, which is minus I am writing. From buying shares you are expecting some dividend. That to be compensated. There are different modes of buying shares, using forward contract, using option contract, using strategies, and there are a variety of modes you can buy the shares. So what would happen? You will create a wing ratio, notional amount of default protection, assuming it is 1.5 billion. Amount of stock purchase, you purchase a stock of say $1 billion. So this wings ratio, shortly known as WR, is 1.5 times. It means with every share I bought 1.5 times of the CDS. What would happen? Google bought Twitter. Google bought Twitter, and Google performed it like an Android. Like we all understand that few years ago Android was nothing. Now Android is #1 operating system of the globe, which Google is performing. So Google bought Twitter, and Google run this in a very beautiful way, in an excellent way. And the share price of the Twitter will from 370 will increase to 250. Now the shares which I bought, I will get a huge capital appreciation because I bought at 37 and current trading price is 250. So I bought at 37 and current trading price is 250, which is approximately 223 per share. This is a huge benefit I would have in the shares front. When it comes to the CDS, Twitter grew like anything, no default happened, so no need for protection, so this money goes. So the huge amount of capital appreciation would little bit offset by the CDS premium which you are paying. You can calculate this in terms of percentage, which we are mentioning here in our video. Wings ratio is known as dividend yield divided by CDS premium. Now dividend yield formula is dividend divided by market price per share. You can calculate the wings ratio also. This way you are able to perform the wings trade using credit derivative, which is credit default swaps. Please note that wings trade is very important strategy for people, those who are here, those who are acting as a seller of the CDS, and sometimes those who are acting as a buyer of the CDS also. These are the four category of the people, those who are actively involved in the wings trade. One is bombed out securities, high asset volatility, binary outcome issues, and leverage buyouts. Not to mention the meaning of this, bombed out equities are those equities which can go anywhere, either here or either here. There are a lot of bombed out companies we have across the globe wherein you never be sure that where they would go. High asset volatility, commodities, precious metals, currencies, sometimes your own IP, like right now information technology. Leverage buyout, we know that there are a lot of leverage buyout cases which is happening across the globe, Leverage buyout perfect case is Tata Chorus. When you taken a huge amount of money and you bond the Chorus, now China is dumping a huge amount of steel in the system and Chorus is failing and Tata want to sell Chorus. Binary outcome which is similar to that, almost similar to that. This is how Wings trade is getting performed. Before winding up the video, let me repeat that Wings trade is equivalent to a protective put. Equivalent to a protective put. When you have one side share and you are selling and you are buying, you are doing the buy put contract, right? If you are doing these strategies in the credit derivative, this is known as protective. This is known as credit derivatives Wings trade. This is very essential. We need to understand these things if you playing in the credit derivatives. If you have any question, you know our contact details. Treasury Consulting LLP @gmail.com, Rahul Magan 8 @gmail.com. Our mobile number is given 9899242978. Our Skype contact is Rahul5327. Hope you like this video, and over the period we'll come up with a lot of other videos as well. Thank you and have a good luck.